So we have four panelists today, some of whom are open here. Adrian from the New York Federal Reserve, Martin Helbig from the Max Planck Institute for Public Goods, Bill Dybvig, whom you know, from St. Louis, and Dimitrios Sofokles from Oxford. So I'll ask them each to make a statement on the topic of the panel, and then we'll open to questions, and you can ask them questions, and we'll have a discussion.
Okay, so thanks very much for having me in the panel, and thanks for organizing this wonderful conference. So I was thinking of using one slide, which is up there. So I don't know whether the panelists can actually see the slides. So this is sort of like a way to frame the debate. So it's a kind of classification of macroprudential tools. And the way that we do the classification is along two dimensions. So one, we're asking what are kind of the segments of the economy where macroprudential tools might be useful. So we have divided up the economy into four segments. Number one are the asset markets. Number two is the banking sector. Number three is the shadow banking system. And then number four is the non-financial sector. So this is sort of like one cut. And then you can think about the kinds of financial vulnerabilities that can arise in these four sectors. And so this might not be a complete list. So let me go a little bit over those vulnerabilities, and then I come to the macroprudential policy, the types of macroprudential policies that might be appropriate for each of the vulnerabilities in each of the markets. So in the asset markets, I think that vulnerabilities that people are worrying about in particular are compressed risk premia, or high asset valuations. So some people call that asset bubbles. I think we generally refer to it as the pricing of risk, or the level of risk premia, as well as the magnitude of volatility. So naively, you could sort of like look at market volatility and say, when market volatility is low, that means that risk is low. But the problem is that when market volatility is low, this might enable leverage and might enable risk taking. So low volatility and compressed risk premia can actually be a sign of trouble ahead, so to say. So that's sort of like the first order vulnerability that people worry about in asset markets. Then in the banking sector, I think there are sort of like two frictions that are primarily on people's mind. One is the cyclicality of bank lending, and the other thing is the kind of risk shifting that is happening due to agency problems. So the procyclicality is that bank lending tends to expand rapidly in booms and tends to contract in busts. And actually, bank lending tends to be more cyclical than market-based lending. So the corporate bond market is actually a stabilizing force relative to bank lending. So corporate bond lending and market-based lending tends to substitute for the collapse of bank lending in busts, at least in economies where bond markets are developed, such as in the US. So the other issue that Professor Martin will be talking about as well is about the risk shifting within financial institutions. So when bad shocks hit, there's a debt overhang problem in financial institutions, which can distort incentives. And so I will refer back to that when talking about the macroprudential policy tools. Then in the shadow banking system, the shadow banking system also tends to be pro-cyclical, and there it's the dealer-intermediated leverage that is the problem. So dealers are intermediating leverage of investors in asset markets, which tends to be pro-cyclical. And in the shadow banking system, you tend to have lots of maturity transformation. There's lots of short-term funding that is supporting lending, and that is often related to regulatory arbitrage. And then finally, there's the non-financial sector, which is the household sector or the non-financial business sector, where I think that the sort of like first order vulnerabilities or frictions that people are worrying about are the level of underwriting standards. So in the run-up to the mortgage crisis, people were worrying about the underwriting standards in the subprime mortgage market. I think at the moment, worries are more or less related to the high-yield market and the leveraged loan market. So you might have followed that there's a big boom in high-yield and leveraged loans, and people wonder to what extent underwriting standards are deteriorating there. So now let's talk briefly about the macroprudential policy tool. So I can't go into detail about all of these different types of macroprudential policies. So we'll just sort of give an overview, and perhaps in the discussion we can go into that in some more detail. So the first thing to note is that they're not really proper macroprudential policy tools, right? I mean, they're macroprudential policy objectives, but the tools that they're using in order to achieve macroprudential policy objectives are the same tools that you use for microprudential policy or for monetary policy, right? So you might move capital requirements for a macroprudential objective, which might be in conflict at some points with a microprudential objective, but there are no really separate tools for macroprudential policy and microprudential policy, or even monetary policy. So the types of macroprudential policies that we understand the best perhaps is related to the banking sector, and so their variation in capital and liquidity requirements is something that has been discussed. In the previous paper we just saw a discussion of sectoral risk weights, but something that is often overlooked in the academic discussion, but which is very important in practice, is the role of supervisory guidance and supervisory stress tests. So supervisors are constantly in banks, and they look at what banks are doing and what is happening in the banks, and they can put constraints on how banks are conducting their business. So they can issue supervisory letters or rules that are constraining the way in which banks are behaving. So that's it's an important tool in practice, which is not really part of the academic literature, but it's something to keep in mind. So macroprudential policy in the banking sector we sort of understand. In the non-financial sector there's also lots of literature, so this is where people think about LTVs and DTIs. And there's some literature because some countries have actually used that. And I think so like the big open issues are related to asset markets and shadow banking. So in asset markets we might not have direct tools, we don't have direct tools to regulate the pricing of risk, which is what we worry about. So there's some indirect tools. So for example, we could set margins or haircuts in OTC markets or on exchanges. So at the moment there's a proposal out by the FSB to set minimum margins and minimum haircuts. And monetary policy might have an indirect impact on the pricing of risk in various asset markets as well. And so the other sort of like open question is about shadow banking. So shadow banking per definition is credit intermediation outside of the regular banking system. So the regulatory reach might be more limited than for the banking sector. And in particular, shadow banking institutions are typically not regulated for prudential purposes, right? Macroprudential policy is a form of prudential policy, and many shadow banking institutions are regulated, but not for prudential purposes, but more for investor protection purposes. And so there's a little bit of a disconnect that is handled differently in different countries. So that's sort of my overview. I'm going to pass it over to the next panelist.
Okay, thank you. Thank you also for the invitation and for the organization of this panel. I would like to submit that we don't really know what we're talking about. As far as I can see it, the term macroprudential has three origins. One was Andrew Crockett's speech before the supervisors in 2000, in which he said it makes a difference whether we are thinking about a single bank incurring a certain risk or about a whole herd of banks incurring that same risk, because the latter has macroeconomic implications. The second, serendipity, the Bank of Spain in the early 2000s wanted to fight the expansionary implications of low interest rates following the monetary unification and introduced countercyclical provisioning. So that seemed to be a wonderful thing to have done. Unfortunately, they forgot about certain other things, such as the cajas and real estate finance. The third one, the recognition that events in 2007 and 2008 could only be explained by a systems perspective. On the basis of those three developments, we've gotten European regulations that provide for macroprudential regulation. Since then, we've seen a proliferation of institutions and a proliferation of instruments. I'm so grateful for Tobias to have listed part of them, but it's already indicative of how these developments are going. Do we know what we're doing? I wonder. Actually, the last time I talked about this, afterwards, someone went up to me and said, shouldn't we just forget about the whole thing and have a very high equity requirement? To which I said, you've obviously read our book. Now, of course, macroprudential regulation is there to protect us from systemic risk. What is systemic risk? Well, it's also a legal term, so we really should have a lawyer on the panel, because the lawyers always know how to interpret the legal norms, never mind whether it makes sense. If you look at public discourse on the matter, there are at least three interpretations. Systemic risk is risk to the financial system from macro shocks. Systemic risk is risk to the macroeconomy from the financial system. And systemic risk is risk from contagion within the financial system. All three are very different animals, but I have not yet seen any proper distinction between them in policy debate. What are the objectives of macroprudential policy? Should they protect the financial system from macro shocks? Should they protect the economy from the financial shocks to the financial system? On the upswing, which is what Tobias was referring to, when you're talking about being prudent, they tend to go in parallel. Because if you try to prevent the macroeconomy from overheating, well, imposing a loan-to-value requirement on mortgage finance may be one instrument for doing so, and by the way, that also helps financial stability. What about the current situation? ECB engaging in targeted long-term refinancing options. Banks, private banks, get certain loans from the central bank on favorable terms if they lend to the real economy. Lending to the real economy may be wonderful for the real economy if that's what you care about, but may saddle those banks with enormous risks. So here you may actually have a conflict between protection of the financial system and protection of the real economy. Which of the two is macroprudential policy about? I once raised this question at a meeting and got 4 answers. 1, macroprudential policy is about helping the real economy. 1, macroprudential policy should not be about helping the real economy, but about helping the financial system. There is no conflict, because if the real economy is in trouble, so is the financial system. There is no conflict, because if you don't repair the financial system, you'll never get the real economy out of the mess. Of course, there is an intertemporal dimension to this debate, but this was 4 answers from 4 very high-ranking officials. On the issue of macro shocks, one thing I observe in various of these institutions is people are thinking about putting all this into dynamic stochastic general equilibrium models, calibrating, and then we know what to expect. Look at history. A major source of macro risk is real estate finance. In the early 80s, the US S&Ls were insolvent because of the mismatch in maturities in real estate finance and the bad outcome of interest rate risk. Late 80s, early 90s, same problem, bad outcome of interest rate risk, except the problems for the financial sector arose not from outright mismatch, but arose from counterparty credit risk under variable rate mortgages. 2007, 2008, the same problem arose because in the context of securitization. So one shock, one macro shock, which is similar across three sets of crises, coming up in a different guise in each crisis, depending on the instruments that are being used and depending on how the institutions work. I think the main issue about coming to terms with these shocks is not to find a once-for-all model and calibrate that, but to look at what's happening and find out what's the story behind what is going on. Where are these people trying to hide the underlying macro risks this time around? Because this time is different, at least in that respect, even though the underlying risks are the same.
So I want to talk mostly about the banking part of this. And I want to talk in particular about the infrastructure that we have. I hear a lot of kind of bragging from regulators about how the banks are safer now, and I hear a lot of calls for higher equity in banks and capital requirements, and those may be justified, but I think we have a bigger problem and a more fundamental problem, and I liked the talk this morning where where Emil said that you can't just use a single instrument, and the problem is that if we look at the capital requirements now, by two different criteria, they're either too strict or not strict enough. And if you look at it at the criterion of keeping banks straight, they're not safe, then it's not strict enough. If you look at the criterion of letting banks do what they need to do for the economy, then they're probably too strict. And I think the problem has to do with the structure of Basel. Basel was constructed in order to give a level playing field and provide some uniform standards across countries. And in order to do that, what we've given up is largely the bank examiners. If we have the bank examiners and the individual countries are doing more regulation as they are now, then we kind of defeat the purpose of Basel, because we lose the level playing field. I think it's difficult to imagine a cadre of international bank examiners who know all different languages and know local business conditions and legal structures in different countries who can go in and examine banks. Because of that, I think that's why Basel has taken this approach of using these coarse accounting numbers. But the problem with the coarse accounting numbers is that the accounting numbers don't have nearly as much information as the bank examiners had previously. And that's why it's hard to do both types of, it's hard to get both of these right. I think it's, if we're asking what should the capital requirement be, we're begging the larger question, which is whether we're in the right regulatory structure. I'm not sure what we can do in order to try to to get this regulation to work. In the crisis, we had both problems because we had this huge shadow banking sector that grew up out of people who weren't being served by the banks, and we also had problems in the real estate market in the U.S. causing bank failures around the world. So we had neither the safety that we would like, nor the banks doing all the things that we probably need them to do. There are possibly some subtle reasons why those arguments aren't right, and there's certainly some room for empirical work. When I was starting out in the profession, which was a long time ago, I felt much more confident in the ability of regulators to regulate banks competently, and I'm not sure whether it's just a regime change that we've gone into a regulatory regime where that's not possible, or whether in fact it was never really very feasible and it just seemed to work for a while. Anyway, that's what I'm concerned with. Perhaps the role of Basel can be moved in the direction of bringing back the bank regulators, the bank examiners who go in and look at the banks in detail, and having the role of Basel be partly to provide standards and monitoring for what those examiners are doing in different countries. So I was just trying to, I don't know if that's going to work or if it's a good idea. I'm just thinking that that's the sort of thing that maybe would allow you to create a level playing field as well as providing the additional information to be able to regulate banks without stopping them from performing their function. I think there's some evidence in this crisis in the U.S. I don't think that bank lending to small and medium-sized businesses has recovered after the crisis, and that's some indication that okay, the bank regulation is tougher, but it's actually causing some problems, and it'd be nice to get that additional information. I was talking with Tarek Rukni last week or the week before here, and it's very interesting. I guess in Germany, the Landesbanks, which are not subject to Basel, have been able to protect the lending to small and medium-sized banks, and it's part of the government, and I think that's an interesting observation. But I don't know.
All the banks are subject to Basel.
They are all subject to Basel.
And it's not the Landesbanken, but the local savings banks that protected their lending, but they are highly profitable and they were not affected by the crisis.
Okay. Well,
because they are restricted to working locally.
Okay. So I don't. So it could be that they. So the other thing that's part of what I'm thinking about, and this may be more appropriate, is that I like Glass-Steagall because it limits people who get money from insured deposits to doing a short list of things that the regulators have a chance of regulating. So I think that's the other side of it. We don't. I'd not like to have. So one possibility is to try to design regulations that say, okay, banks can do all these different things, but we'll give them the incentives to do the right things. I think it's safer to say, okay, banks can do a very limited set of things if they want to get these insured deposits. And I think that was a good feature of Glass-Steagall. Glass-Steagall got a lot of bad press because one of the reasons it got passed is because Huey Long, the great populist Louisiana politician, hated J.P. Morgan's guts and wanted to break up his bank. But if you read the other things that were going on, a lot of them were correct. It says so long as the government's going to be on the hook for the deposit insurance, then you need to have some limits on what kind of risk they can take.
Thank you. Thanks for the conference, and it's very nice to talk after your co-author has done a great job in the morning. Your teachers have done an even better job. So, it's very easy. to talk. And in fact, I want to start with what Martin said about the definition of what we are trying to talk about, macroprudential regulation. Because I remember when I got started in this business in the Bank of England, and they talked about financial stability, my first natural question is, if you want to model or to give an analytical argument about financial stability, and there were some senior people at the time, could you please tell me what is financial instability? Well, there were 4 in a room. I heard 6 or 7 definitions. One of them was Andrew Crockett's. So I think a key challenge is to be able to identify and have a straw definition of macroprudential regulation and financial stability. As far as financial stability, after having searched for many years, I think Eric Rosengrant's definition that he gave in Stanford 2011 is closer to what we may perceive as the least common denominator, namely that financial stability reflects the ability of the financial system to consistently supply the credit, intermediation, and payment services that are needed in the real economy. And financial instability occurs when problems within institutions, markets, payment systems, or the financial system in general impairs the supply of credit intermediation service so as to substantially impact the expected path of real economic activity and consequently growth. So if we have this kind of as a straw definition, then one needs to establish some principles with respect to which macroprudential policy should operate. And since the bread and butter of macroprudential policy is this special sector of the economy, the banking, one has to refer back to the functions that Anil spoke about this morning, namely liquidity, insurance, risk sharing, credit extension by maturity transformation, and any macroprudential analysis should be able to target and dissect these 2 principles. And the second principle should be that since savers and intermediaries interact, and regulation, in other words, the constraint optimization problem changes as we vary the constraints, then one has to have arguments whereby savers are not morons and they are rational and they are forward-looking. And in plain English, we should have rational economic agents with incentives that operate in markets. Now, if we buy this kind, which is not a very easy thing to buy, this kind of an analysis, then I fully agree that one cannot find a canonical model only in religions. One has a hallucination that you have a canonical book, but one can establish a canonical framework. And then the framework can be appropriately adjusted and implemented in context-specific situations. And from what one can do using this framework that addresses systemic risk, contagion, and everything that we are talking about, and as far as I am concerned, when we talk about these 3 words, we talk basically about heterogeneity. So the good old fiction of the representative agent, it is not adequate for macroprudential regulation analysis. And you talk about the main manifestation of financial stability and instability that macroprudential policy is trying to rectify, namely default. And that's, I know that tomorrow, unfortunately, won't be here. Somebody will going to be talking about default extensively. And it was very interesting that he took 2 global financial crises so that academia to start incorporating default as an integral part of their analysis. To me, the lack of having default in any framework is like trying to perform an operation whereby the patient is absent for the operating table. So default is key. Also, you need to have rational economic agents that do things. In other words, to invoke, when I say do things, you have to minimize, even though today I had an argument, and I was convinced that it was not so correct, to minimize the number of agents that do nothing, the number of agents that are all risk neutrals. This way, when you have markets and active agents, then you have gains from trade, then you have equilibrium outcomes, and then you are susceptible and you can perform comparative statistics and you can dissect and assess regime changes. Ultimately, what one wants to do is to maximize the distance between what you assume and what you conclude. As a late friend of mine, Sudipto Bhattacharya, used to say when he was refereeing papers. Then, basically, the main conclusions of this kind of framework, at least what I can take and from my policy involvement and my research, is that, again, the principle that Anil mentioned in the morning, that you have not one externality, you have more than one externality, more than one channel, therefore it cannot be possible to use a silver bullet to kill all the flying birds. You need as many tools as externalities present. And in fact, something that's a criticism usually to many complicated models, that there are too many things are happening, well, a policymaker, and actually worse than the policymakers and the regulators are the politicians, we better see all the channels and then we select and elect the important channels that one can focus. So this is that goes back to the Timberian principle, as many objectives, so many tools. Then the second main kind theme that recurs in all of these financial macroprudential financial stability models is the issue of constraint inefficiency. That it is not that we are in a second best world, in fact we are in a third best world. That given the frictions that we introduce in our thinking, still by playing with the constraints of the system, which are the regulatory constraints, one has to assess whether we can implement welfare improvements and improvements in the real economic activity. So constraint inefficiency is, as we saw in the last talk, an important consideration that regulation should focus and try to implement welfare improvements. And as Martin said in a comment this morning, for that, for better or worse, you need more general equilibrium. And I take general equilibrium as more agents, more channels, and more markets. And then you try to make sense out of what you create. And then last, but not least, one has to dissect and to separate, to split, if you will, regulation with respect to the object that it targets. If it's an institution-based regulation, this is the good old macroprudential regulation, and then the state-dependent, market-oriented regulation, this is the new thing that the global financial crisis brought us, and this is nothing more than the macroprudential regulation. So having these sort of principles, one can come up with frameworks that, if you adjust them and implement them in context-specific situation, one can have useful conclusions that one cannot hope to be as robust as monetary policy conclusions used to be in the past.
Well, thank you. So we're opening to the floor now. Andre?
Can you hear me okay? Thank you very much for your remarks. As you were speaking, I just sort of heard a lot of things about definitions and the policy measures and the sort of some specific things. So let me start with definitions. How about this definition for systemic risk? So risk is typically defined as a deviation either from expected value or from a given target. Systemic risk is a deviation of a financial system from either how financial system is expected to perform or how it's supposed to perform according to what regulators think it's supposed to be. In that second column, financial vulnerability, I see where it's excessive, more than. So to me, it sort of means like there is some sort of target level according to which the financial system is supposed to perform, and it's supposed to not deviate from that level by too much, right? And then there are some measures that are designed to do that. Of course, the difference between target and expected is also very different, right? So I'd like to maybe ask each one of you maybe to comment on that and see whether or not in your own mind you've sort of crystallized, if you've had it, that is it supposed to be deviation from expected target, which could be anywhere. The financial system could go, is expected to be in a bubble, or is expected to be flat, or expected even to shrink, right? Or some target level. And what would you define as deviations? Risk is symmetric, right? There are upside things and downside things. If you stay within this definition, how does it fit into just sort of what you were saying? Whoever wants to comment, each one of you, I'd like to hear from each one of you, but if you wish to pass it on.
So I would like to answer your question with an example. So it's an example of a flavor of a macroprudential policy that has been implemented by the Federal Reserve, I think, around a year ago, and it's related to examiners actually. So it's going to Phil's point. So it's supervisory guidance that was issued in relation to leveraged lending. Okay, so when you look at the U.S. today, and when you sort of like try to detect where is risk building up, as Martin was pointing out, right, we should be looking where is risk hidden or where is it building up. Then, so like the leveraged loan market is one market that many people have pointed to, many policymakers as well as market participants. And so basically what's happening is that in the low rate environment, there's a kind of reaching for yield. And how do you generate yield? Well, you have to find leverage somewhere. So you invest in leveraged debt of companies. And so high yield issuance is higher than it has ever been historically at the moment. And many of the leveraged loans are sold into CLOs. So like today's securitization market in the US is booming in certain segments, which are the collateralized loan obligations. So what's the supervisory concern? Well, there's a microprudential perspective on this buildup of risk, and there's a macroprudential perspective on this. So the microprudential perspective would be to say that you go into the bank and you look at the underwriting standards that banks are using for these leveraged loans. And then you could tell the banks, well, you have to stay within limits in terms of extending underwriting standards or in terms of expanding leverage of the non-financial sector. Now, the guidance that was issued by the Federal Reserve had a macroprudential flavor, and that was saying that so banks that underwrite levered loans have to stay within guidelines regarding, say, the leverage. This is sort of like the first order thing. So how much leverage can the leveraged loans have? So there has to be a constraint on the leverage, even if those loans are sold to other market participants. So in particular, even if they're sold to CLOs, for example. So the CLOs might be owned by hedge funds and private equity funds, which are completely outside of the banking system. But the supervisory guidance is saying that banks can only issue leveraged loans that are compliant with the guidance, even if those loans are sold to some other part of the system. And so that is a kind of macroprudential policy that is addressing one particular area of concern, and it's implemented by supervisory guidance. So it's done by the people on the ground, by the examiners that are sitting in the banks every day.
So it's a target. It's a set target.
Exactly. So now, then you can ask, well, so what's the notion? So what is the notion of excessive, right? And I think there's a difference between writing down a model and sort of like being an examiner, right? So of course, when you write down a model, you have a notion of first best, and then you can ask, well, what is the constraint second best that the social planner would implement? And this is, so when I say, well, excessive risk taking, this is always the difference between what is implemented in the marketplace and what a social planner or policymaker would implement. For people on the ground, of course, I mean, they have to define something that is excessive, and in practice, of course, that's much harder. So in the case of leveraged loans, there's a call that was made that some level of leverage seems to be excessive. And if you write on a theory, of course, you can define that level of leverage that is excessive very precisely, because you know what is first best, what is second best, etc. In practice, of course, you have to make a guess about what that is.
I think it's important in this context to think both in terms of procedures and in terms of institutions. Procedure, much of this does require judgment, and we should not fool ourselves into believing that judgment has much to do with welfare maximization. It's very much a rule of thumb affair. Institution, and of course this is precisely what you were referring to when you were referring to bank examiners, as opposed to people who would just be following rules. But of course, if someone exerts judgment, the parties affected are likely to challenge, and then the lawyers come and say, what rule did you apply? And there may be a problem. In terms of institutions, there is an issue of perspective. The traditional microprudential authorities tended to look at each institution in isolation without appreciating systemic interdependence and without appreciating that some risks might have been swept somewhere under the rug where one just couldn't see them. The macroprudential authorities that we're looking for should be taking a systems perspective, but to be quite frank, in the official sphere, I have yet to see a paper that really tries to assess systemic risk on a systems perspective without looking at it institution by institution. It's very hard to change that frame of mind.
So I guess I agree with a lot of the comments made so far. I think that conceptually, I think that the level of risk, the target level of risk, is a means, not the end. As you say, and you have some general policy goals about how well the economy would do and so forth. And those goals, which could be codified in social welfare or something, are the ultimate goals. And that, in principle, that's what you would test against. Of course, you can't. But then when you operationalize it, it's hard to tell a bank examiner to say that you have to go in and maximize the social welfare function. And so you have to come up with some benchmarks. And I think you come up, and that will be influenced by judgment. There can be some rules. I know in the U.S. the lawsuits that I know about. There's one lawsuit I know about where the owner of the bank sued because they thought that the examiners were unreasonable in closing down the bank, and there's a lower court decision that said that the examiners were, quote, arbitrary and capricious, and that was overturned by a higher court which says that they're allowed to be arbitrary and capricious. They're using their best judgment, and so I think that in the U.S. anyhow, I think that goes in the favor of the examiners being able to execute their discretion. There's an interesting problem here, which is parallel to the problem that accountants have. It used to be 100 years ago, accountants had a job with their auditing firm of asserting that or verifying that the books accurately represent the economic situation of the firm. And over time, I think partly to allow the accountants to avoid litigation, that task has changed into verifying compliance with GAAP. And the bank examiners, the way that I understand, we're supposed to have form an opinion about the safety and soundness of the bank. And that's pretty vague in terms of what target risk level it is, but I'm sure that in order to operationalize that, they have to have some models in mind and some targets that are within the context of the models.
I don't have much to add except one point. The purpose, at least to my mind, of macroprudential regulation is in general is not to provide quantitative advice and quantitative prescriptions. For me, the main target is to prevent gross mistakes to occur. The perusal of Tim Geiner's book, you will see during this whole crisis how much worse things could have become had not been used some well-established frameworks. It's one thing to avoid quantification of everything and reverse engineering of trends, and another thing to claim that systematic frameworks should not and are not available in order to avert us from committing gross mistakes. And the primary example, the last 4 years, is what is happening to Southern Europe, where wrong policies have literally decimated half of the Eurozone. Not to talk about my own country.
I have a question for the panel. So you're saying that one should not go to quantitative, levels when talking about these things, but in fact, regulation is quantitative by nature because they're prescribed with capital ratios, there are leverage ratios now, there are other limits on various types of risk. So these are all quantitative limits. It's true that regulators have some discretion in how they apply it, but still, if you define the range to be 8% or 30% or 10%, we're not talking about the same thing, really. So there is, at some point, that needs to be quantitative. And I guess there is an increasing call for some kind of systematic or model-based cost-benefit analysis, because when you want to reach some level of agreement on these numbers, you have to have some model behind it. You can't just have it done completely out of the air. So, and then you were also referring to the fact that any serious model which addresses these issues needs to include, in particular, heterogeneity. We insisted on that. But so we've had a lot of workshops and talks in this semester. I was struck by the fact that a lot of the macro models being presented, and with always a slide on policy implications at the end, were actually not based on heterogeneous representation of neither the banking sector nor of anything. They were really focused on one bank, one firm, and so on. So I'd like to ask you, some of you at the forefront of this type of research, what do you think is the state of this research? What's really lacking in terms of the modeling that needs to be done to address these questions? And what are the biggest challenges? Why do you think they haven't been addressed in terms of difficulty of modeling?
That's a tough question.
You'll get heterogeneous answers.
I mean, so I think one important thing to keep in mind is that many of the models that we have seen are difficult models and complex models, but they're all like very gross simplification of the real world, right? We use models to understand what's going on in the world because the world is that much more complex, right? And so, so I think in a lot of the models that we're writing down, we we look at capital requirements or liquidity requirements, but in practice, there are many shades of that. So, liquidity, actually thinking about liquidity, there's a lot of detail that goes, for example, into liquidity regulation. So, understanding the liquidity profile of a major bank is actually a very hard thing, because you have to look at all the contractual details of every single debt contract of the firm and every single loan that the firm is giving, right? So you have a very, very highly dimensional kind of problem where, you know, just capturing this kind of data in a database that is understandable is actually really, really hard, and takes the examiners who do this every day years to actually do. So in that sense, I think, you know, I think we have to keep in mind that we're still dealing with models that are much simpler than what is out there in the real world. So a second thing is related to Basel. So in research, I think we focus very much on a couple of numbers. And we tend to forget that these are minimum requirements, but that there's enforcement that is sort of like soft enforcement that comes from looking at the banks on a day-to-day basis. That is also an important part of regulating the banking system, and that in turn feeds into the writing of the Basel rules or regulations in general. So there's a kind of like dynamic back and forth. Like, as the financial system evolves, you realize that certain rules can be circumvented very easily, or that there's risk-taking in one particular pocket of the financial system, and that in turn triggers a rewriting of rules or of guidance, or it goes all the way to Basel. So I guess keeping in mind that, you know, the kind of models that we write down are still sort of like fairly simple representations of what's actually going on in financial institutions. That's important. I mean, the good thing is there's a lot more research to be done. So
I think in this discussion one needs to distinguish between the models that the banks use for Basel and between the models that a macroprudential authority might use for assessing macroprudential risk or systemic risk. On the models that the banks use for Basel, there are two issues. One, certain risks, and I mean substantial risks that have been responsible for some of the major crises of the past 25 years, have a statutory risk weight of 0, which makes the whole exercise ridiculous. Second, there is significant manipulation of risk assessment by the interested parties, and there's empirical evidence on that. On the issue of what would a macroprudential authority do, which I think in the context of this discussion is the real issue, here's a challenge for all modeling. What's the time structure? We've had a number of papers. We are going to hear some more papers, and none of them has reflected on what was the assumed time structure. The last paper this morning was about fire sale externalities due to solvency problems, due to lack of equity. The time scale on which that dynamic occurs in the real world is a very different time scale from fire sale externalities in the context of needing cash because of liquidity problems. So here's an example where timescales are different. The buildup of risks in the loan book, such as subprime mortgage lending, takes a few years. The buildup of risks in the trading book, such as the London Whale, takes a few days. Do we have any model that allows us to accommodate differences in timescale of different dynamics? I think we need to think much harder about what exactly we mean by this t equals 0, 1, 2, 3.
So I actually don't have that much to add, so I'm going to pass. We're close to the end. Yeah, I'll give you a chance to talk.
Well, let me give a slightly homogeneous answer rather than heterogeneous answer. For sure, Models are arguments. Models are abstractions. And no model can capture every single little detail of an economic phenomenon. But the main point, as Tobias said, of a model is to give a well-defined, legitimate, easily understood argument. And the thing I add is what I mentioned before, the distance between assumptions and conclusions. And when it comes to financial stability, at least in my opinion, and to macroprudential policy, it's a matter of channels and externalities. The more of them you have, the more interaction, the more trade-offs, the bigger the distance between assumptions and conclusions. And as I said in the beginning, I don't believe in canonical models, but I believe in canonical frameworks. And regarding to your question, why not all these years people are not doing about heterogeneity and all that in all the seminars and the conferences, I've asked myself many times the very same question. And I think the answer is what once a professor of mine at Yale gave me when I asked why so many people are doing behavioral nowadays. Have the investors changed their behavior? And is everything different? And his answer was, well, it's easier. To do the real thing takes time. You have a behavioral thing, you tweak your preference, a utility function, you're all set. And last but not least, with respect to numbers. Numbers in economics have a problem, by definition. Therefore, numbers, they should not be treated as gospel, but indicative. The very same way, when you have inflation targeting, why not 5%? Why not 4%? Nevertheless, you need to have the numbers, but you should not be a blind hostage of these numbers. What matters are the channels and the trends that possibly all this sort of analysis can offer to us.
I'll respond to that. because I think I like to think there are two types of models, toy models and realistic models. Toy model is not a pejorative term. My most famous paper is a toy model. Toy model is like a crystal. It's something that's extremely simple that allows you to understand what's happening, on the basic idea, the internal consistency of some economic ideas. So the diamondific model that I did many years ago with Doug is a toy model. You can't think of estimating this, bringing this directly to data. It doesn't make sense. But hopefully it gives you some insights and helps you in your thinking about things. Another kind of model is a realistic model, like Black-Scholes. You may not like the constant volatility assumption of Black-Scholes, and you may think we need a more refined model, but it's a model you can realistically just take to the data and test it and see whether it fits or not. And that can lead to a more sophisticated, more elaborate models that have stochastic volatilities, interest rate risk, whatever that are more realistic and maybe will fit the data better. But I think those are two very different purposes of models, and I think both are useful.
I disagree on Black-Scholes.
Okay.
Black-Scholes is a model about a complete market system, and I don't think we have a complete market system.
Well, that says it will be rejected, not that you can't bring it to data. That you expect it to be rejected.
I think these are very interesting issues. So on one side, you were saying that our models are not as complex as reality, so this means that probably our model should be more complex. On the other hand, of course, so the data that you have, I don't know how complex model can allow, how complex model can you validate, or can you really think make sense to study it? On the other hand, I don't really think there is a difference between toy models and realistic models, and we know. I'm a physicist, so in other branches of sciences, you know that, of course, there is a degree of the number of details that you neglect. Go from an easy model to a model of a real magnet. there is a number of things that you have to put in, but essentially the kind of macro behavior that you get from the toy model is the same that you get in the data, and essentially unless you are able to have very precise measurement, you cannot estimate anything more than a toy model on your data. I mean, this is I mean, my view of coming from physics. Then, of course, economics is much more complex. And final thing, I mean, just so, of course, there's been all this increasing complexity, and it looks like our complexity, the complexity of models and complexity of regulation is essentially trying to follow on that. And I, especially when you talk about macro policies or to regulate macro, I wonder whether really one should go towards more and more complex type of policies, or whether this makes sense. I mean,
So yeah, so what I was saying earlier, the implication was not that I think that we should have one gigantic, very complicated model that captures everything in the world. What I had in mind is that there are many different economic forces that are at play that simple models can capture, and I think you do need simple models in order to understand economic intuitions and economic forces. But once you go to policy, you do need to take all these different dimensions into account, and that's like I think in research we can isolate particular mechanisms very clearly, but then in practice you have to take many different mechanisms into account at once and have to weigh them in some ways. I don't think that it's possible to build everything into one gigantic model. I don't think that's the aim at all.
Okay, so I suggest to close the discussion and continue over tea, coffee. Thank you to all.